All right, let's cut to the chase. Apple just reported earnings and Wall Street is buzzing. We're talking $94 billion in revenue, a clean beat, and yet the stock barely moved. What's going on here? Is Apple's Q3 a turning point or just another blip in a rocky 2025? If you've been wondering whether it's time to buy the dip, hold your shares, or run for the hills, stay with me. We're breaking down Apple's Q3 earnings line by line, looking at what really matters beneath the headlines. Whether you're a long-term investor or just watching the tech sector closely, this breakdown is for you. Let's dive into the numbers, the market reaction, and what's next for the world's most valuable brand. First up, let's talk revenue. Analysts were expecting Apple to report $89.2 billion in revenue. Apple dropped a bombshell and posted $94 billion. That's more than a 5% beat and one of the biggest surprises of this quarter across the market. EPS came in at $1.57, crushing the $1.43 estimate. That's another solid win. So why didn't the stock skyrocket? Well, it's complicated. Despite these beats, Apple stock is still down more than 14% year-to-date. Investors were clearly expecting more. Maybe news on product innovation, AI leadership, or a bullish forecast. The financials were great, but the sentiment? Still a little cautious. Now, let's talk geography. One of the biggest surprises in this report came out of China. After several tough quarters, Apple posted a return to growth in the region. This is huge. China is a critical market for Apple, and recent regulatory hurdles and local competition from brands like Huawei had Wall Street spooked. But this quarter proved that Apple isn't backing down in international markets. Growth in China could be the key narrative shift the stock needs and might signal smoother waters ahead, especially if geopolitical tensions stay muted in the near term. Let's zoom in on services. Tim Cook called it out specifically. Services revenue hit an all-time high. Now, Apple didn't break out the exact number, but we know this segment includes iCloud, Apple Music, the App Store, and more. Services have higher margins than hardware, so continued growth here supports Apple's overall profitability. With gross margins at 46%, right on the nose of analyst expectations, this business unit is quietly carrying a big chunk of Apple's future. That's especially important as iPhone sales mature and global demand softens. And speaking of the iPhone, there's something interesting here. U.S. telcos reported 22% growth in equipment sales this past quarter. That's the best in 6 quarters and suggests strong iPhone 16e demand. That's the model Apple launched earlier this year, and it looks so even as the hardware refresh cycle gets longer. Apple is still finding ways to keep the product ecosystem sticky and relevant. Let's not forget cash flow. Apple generated $25.7 billion in operating cash flow, another strong number. They also raised their dividend to 2 cents per share and authorized up to $100 billion in share buybacks. That's classic Apple. They might not always promise flashy new products, but they consistently return capital to shareholders. For long-term investors, this remains one of the safest cash flow machines in the world. And with the Fed likely holding rates steady, yield-hungry investors might once again see Apple as a safe harbor. Now let's put this in broader context. Apple's year-to-date return is still negative. Compare that to Meta, Nvidia, and Microsoft, all of whom are riding the AI boom and showing strong double-digit gains. Apple, in contrast, has been criticized for lagging in artificial intelligence. There was no major AI announcement this quarter, and that silence is speaking volumes to some investors. Until Apple outlines a clear AI strategy or product roadmap, the market may continue to reward its big tech peers instead. But here's where things get interesting. Tim Cook didn't directly mention AI in the earnings call, But we know Apple has been quietly building capabilities. Their on-device processing power, thanks to Apple Silicon, makes them uniquely positioned to deliver AI experiences privately and efficiently. Think real-time transcription, image recognition, and intelligent automation, all happening on your phone. Apple may not be shouting from the rooftops like others, but don't count them out of the AI race just yet. Let's talk investor sentiment. Despite beating expectations, Apple shares only moved about 2% in after-hours trading. Why? A lot of institutional money is sitting on the sidelines, waiting for a signal. They want clarity on where growth will come from in 2026 and beyond. Will Apple break into new product categories like AR, VR in a meaningful way, or stay tethered to iPhones and services? The next 6 months will be critical for shaping investor confidence, especially ahead of the holiday quarter. What's the final takeaway? Apple delivered a clean beat on revenue and earnings. Services in China showed strength, and the company is returning billions to shareholders. Still, the stock reaction was muted, reflecting investor caution about future growth drivers, especially in AI. If you're a long-term investor, this quarter offers reassurance that the fundamentals are still solid. But if you're looking for near-term catalysts, keep your eyes on product announcements and possible AI integrations in the next iOS update. Apple's not out of the woods yet, but they're still playing chess while the market watches checkers. Let's now unpack the Magnificent Seven comparison. Year to date, Apple is trailing almost all of its mega-cap tech peers, down roughly 14.7%, while Meta, Nvidia, and Microsoft are up between 27 and 30%. Even Amazon, with a weaker quarter, is still outperforming Apple. This underperformance has put pressure on Apple to show investors that it's not falling behind in innovation or relevance. The company still boasts the largest active install base of devices globally, which gives it unmatched platform leverage. But the street is clearly saying, show us what's next. Apple's stock may remain under pressure unless it starts delivering bold, new narratives. One area that didn't get much spotlight this quarter, but deserves mention, is Apple's environmental progress. Tim Cook highlighted that Apple has cut its carbon emissions by 60% over the past decade. For ESG-focused funds and climate-conscious investors, that's a big win. It also aligns with Apple's long-term strategy of controlling every layer of its supply chain, from custom chips to materials to energy sourcing. These efforts may not spike the stock overnight, but they help protect Apple's brand equity and regulatory position in an increasingly sustainability-focused global market. So where does that leave us? Apple's Q3 results are a reminder that the company still delivers where it counts: strong cash flow, global reach, and loyal customers. But the muted reaction in the stock tells a deeper story. Investors want more than just solid numbers. They want vision. Whether that comes from AI, new hardware categories, or subscription innovation, the ball is now in Apple's court. For now, the fundamentals remain rock solid. And if you're playing the long game, Apple still looks like a cornerstone tech holding. But for the short-term traders, it's all eyes on the next move and Tim Cook's next big reveal.